So, calculation of NAV in case of self-occupied property is pretty simple, where NAV is assumed to be 0. From that, you can deduct only the interest on borrowings for constructing or acquisition of the assets, but there's a restriction, either 30 or 2 lakhs maximum, 30,000 or 2 lakhs can be subtracted. So from this, it is very clear we'll always face loss. Now, how many house properties you can possess? Maximum 2 house properties can be used for self-occupancy purpose. If it is more than 2 house properties, then the house properties beyond the 2 house properties will be considered as deemed to be let out. Deemed to be let out. And flexibility of choice. So A, B, C. All the 3 house properties, house property A, B, C, are used for your self-occupancy purpose. So as per the provisions of this one, you can consider this being self-occupied, and this will be let out, deemed to be let out. Is that okay? DLO. And this is your option only. Either you can consider this being a DLO and these two being self-occupied, or this will be DLO and these two being self-occupied. You can think or calculate all the 3 options and find out the most beneficial for the taxpayer. That option you can choose. This option will be exercisable year after year. In this year, you consider the C being the deemed to be let out. In the next year, considering A being the DLO, so that it will be more beneficial. Can I change? Of course, you can change. Each and every year, you can choose your own methods. The owner can choose which 2 houses to treat as self-occupied each year and residential units. This rule does not apply to multiple residential units within a single property. This will not be applicable. In case of flats, in case of flats, simply they break these walls and making 2 flats into single flats for their requirement. 3 or 4 flats. If 4 flats are going to be combined into a single residential house property, then it will be considered a single house property only. Is that clear? Hope you will be now able to understand this logic. Now, in case of deemed to be let out, how can we calculate, sir? In case of deemed to be let out, your GAV is equal to estimated rent, expected rent. Of course, there is no real rent received. As you yourself occupying, you don't get any rent. As you don't get any rent, the expected rent will be your GAV. From that, all the concepts what you follow in case of let out, you can follow. So minus municipal tax, and you will get NAV. From there, standard deductions deductible under section 24 class A at the rate of 30% and interest. So finally, you will get the income from house property. Is that clear? Expected rent will be the GAV, municipal tax, and NAV. Standard deduction as well as interest will be subtracted. Now let's see. To make this concept clear, we'll solve this illustration. Pooja has occupied 3 houses for self-occupancy. So all the 3 houses are going to be used for self-residential, self-occupancy purpose only. You are means now the number of houses for the self-occupancy is restricted to only 2 houses. Right. How can we solve this, sir? Very simple. Consider all the house properties being self-occupied and then find the value here. If all the house properties are considered as self-occupied, what about your NAV for house X, Y, and Z? NAV is 0. Only interest can be subtracted. Interest. Okay. Municipal value, municipal taxes paid, fair rent, standard rent, repairs will not be considered. Ground rent paid will not be considered. And insurance premium paid not considered. For all the expenses related to the house property, a standard deduction 30% will be given as a flat rate. You cannot claim further. So these values are to confuse you. And interest on loan taken for house property 75,000, 1 lakh 20, 2 lakhs. If the loan borrowed before 1/4/1999, this one, okay, the maximum interest deductible being only 30,000 in case of self occupancy. Is that okay? In case of Y, 2006 and 7, 1 lakh 20. She has suffered loss. Before we go further, we'll try to finish up the other adjustments also. She has suffered a loss in her business amounting to rupees 3 lakhs. House Y is constructed in 6 years. So to claim the higher deductions, 2 lakhs, two conditions should be satisfied. Condition number 1 is the loan should be borrowed on or after 1/4/1999. Second will be the loan should be used for construction purpose, means the construction should complete within 5 years. Completion of construction should be less than or equal to 5 years. And third one being interest payment is only meant for this purpose. That's why you have to get the certification from the lender also. Okay, you need to get the certification. Compute her total income, advising her which house should be specified for self occupancy, whether X or Y or Z. Okay, so now we have to decide which among these three house properties will be considered as self occupied or deemed to be let out. For this purpose, you first consider all these things being self occupied, recalculate all the three as being deemed to be let out. Then you can go for a permutation combination to guess which may be considered as deemed to be let out. Is that okay? So for the case of Y, the deductions being only how much? 30,000, because the construction, though the loan borrowed after 1/4/1999, but the construction takes more than 6 years. The last one being 2 lakhs, nothing stated, so we assume entire 2 lakhs can be deductible. From NAV, if I subtract the interest under self-occupied property, you always get the income from house property loss only. 30,000 loss, 30,000 loss, 2 lakhs loss. Now assume, if I think this may be deemed to be let out, how this will be? Deemed to be let out. In this case, municipal value, fair rent, between these two, whichever is higher will be taken. The value being 3 lakh 60, 9 lakh 60, 9 lakhs 50. Fair rent being 5 lakhs 40, 8 lakhs and 10 lakhs. Between these two, whichever is higher will be taken. So 5 lakhs 40, 9 lakhs 60, 10 lakhs. And you have to cross verify with the standard rent that it should not be beyond this, whichever is lower of these two. Standard rent in this case being 4.5 lakhs, 6 lakhs, 9 lakhs. So between these two, whichever is lower, 4 lakhs 50, 6 lakhs, 9 lakhs. This is what about your expected rent. The expected rent in this case is equal to GAV. From that, we have to subtract what? Municipal tax paid. As it is paid, we can subtract directly. 40,000, 80, 90. Now, your NAV being 4 lakhs 10,000, 5 lakhs 20 and 8 lakhs 10,000. From here you can subtract standard deduction under section 24 class A, 30% on this, 1,23,000, 1,56,000, 2,43,000. Then you can claim the deductions for interest paid for the borrowings for constructing the house property. The interest in this case being 7,50,000. The 32 lakhs limit is applicable only for the self occupancy purpose. In case of let out, you can directly take the full value 75,000, 1,20,000, 2 lakhs. Now your income from house property, if it is being the deemed to be let out, you have to subtract these two from the NAV. 2,12,000, 2,44,000, and this will be 3,63,000, 67,000. Okay. Apart from that, we have been given there's a business loss, PGBP loss being 3 lakhs. Now it's our time to choose which among these three will be considered as self-occupied and deemed to be let out. For the combinations X, Y, Z, I assume this one and this one being self-occupied, this will be the deemed to be let out. This is the first assumption. As per this assumption, what about your total income? 30, 30 and 3,67,000 will be taken. If X being self-occupied, there is a loss of 30. Y being self-occupied, 30,000. If Z is assumed to be deemed to be let out, 3,67,000 will be taken. Then the ultimate value, provided any number of house property, number of house properties can be used for self-occupancy, but the overall limit for interest deduction is 22 lakhs only. So 30 plus 30 put together, it's only 60. So we can claim the entire 60 being the deduction. So 3,07,000 will be the taxable income from house property under this option. Second case, I assume this one being self-occupied, this one being self-occupied, this one being deemed to be let out, and this will be self-occupied. I am shifting slightly. Rather than Z being the deemed to be let out, I make Y being the deemed to be let out. So in X case, 30,000 loss. As we now consider Y being the deemed to be let out, so revenue in this case being 2,44,000. Z being the self-occupied, then the value being 2 lakhs loss. Now remember, the overall deductions for the self-occupancy property being only 2 lakhs. 2 lakhs plus 30, 2 lakhs 30, anyhow restricted to only 2 lakhs negative. From 244, 2 lakhs negative is subtracted, so 44,000 will be the income from house property. Let's move on to the next option. I consider X being the deemed to be let out, remaining 2 being self-occupied. If I go this option, deemed to be let out of X will be considered for taxable purpose at the value of 2,12,000. In case of Y and Z, will take the loss only, 30,000 loss, and here 2 lakhs loss. Any of these two put together restricted to how much? Only 2 lakhs. From 212, if I subtract 2 lakhs, 12,000 will be the gain here. The most favorable situation being this one. Lower taxable income will be most favorable for the assessee. So you have to choose this option. X being the deemed to be let out and Y and Z being self-occupied. With that, business loss can be adjusted. Business loss can be adjusted. So this will be the most suitable options you have to choose for this current year. Clear? If it is clear, text me. Now, so what are the practical problems you may encounter in this chapter? Calculation of NAV. In case unrealized rent, how can we adjust? In case of vacancy allowance, how can we adjust? Let out for residential or commercial purpose, the treatment will be the same. Self-occupied for residential purpose. In case of commercial purpose, it is not going to be considered under income from house property. The maximum number of house properties can be used for self-occupancy purpose being 2. If you are having more than 2 house properties for self-occupancy purpose, that will be called as deemed to be let out. This will be called as deemed to be let out. Clear? These are the cases we have studied. Interest on loan and limit of deductions of self-occupancy also we have studied. In case of self-occupied property, maximum interest deductible is 30,000 or 2 lakhs. Is that okay? So we have completed. These are the cases. Few more aspects to be covered for the income from house property part being third one, fourth, fifth, sixth, seventh. The third one, partly let out. So partly let out means 1/4/24 is the commencement of the previous year, ends on 31st March 2025, where from 1st July 24 to 1st January 25, this period it is occupied for residential purpose. This period let out and this period let out. So part of the year let out, part of the year self-occupied. Then how can we treat? How can we treat? This is called time-based let out. Time-based let out. Is that okay? In this case, you calculate the entire thing as let out only, and this period unrealized rent, this period rent will be considered as unrealized rent like. It is not unrealized rent, you consider this being the unrealized rent like. So rest of the process will be the same. Okay, calculate expected rent minus rent received. Rent received is nothing but annual rent minus this unrealized rent. Then you can compare whichever is higher, and that will be the GAV. That's all. So this will be letting out partly, part of the year let out, part of the year self-occupied. In another case, in house property, they have 2 unit houses like within the same house. Maybe first portion may be occupied by the owner, and this may be let out. May be possible. This is self-occupied. This is let out. Or ground floor may be occupied by the owner, and first floor may be let out for somebody, some tenant. The entire thing will be considered as one house only, but a portion is let out. Then how can we calculate? So it is nothing but partly let out based on the area. So part of the property is let out area wise. So time wise and area wise. Sometimes we may have the combination of both also. So in this case, no, the expected rent calculation, usually municipal value, fair rent, and standard rent, everything will be available for the entire house put together. Maybe municipal value may be 1 lakh. You understand that self-occupied and let out being 50-50%. 50% of space is for the self-occupancy, another 50% let out. Then this 1 lakh for this portion will be considered as let out, for this portion may be considered as self-occupied. For the self-occupied, NAV is equal to 0. That's how you can start. But for the let out, you can proceed with the normal let out procedures here. Is that clear? If it is 60-40, then you can follow the same procedure here. Clear? So we may have the part of the year's let out, part of the property let out. Both the concepts here are combination of these two. So let's now start with that one. Beforehand, one more provision already we have discussed. NAV, annual value will be nil for what? Newly constructed properties. In the very first itself, I told you, right? So the builders, they construct the flats and sell the flats. If the flats remains unsaleable for more than 2 years, up to 2 years, no problem. More than 2 years remains unsaleable, those unsaleable period or property will be considered as deemed to be let out. No other way you have to pay the tax, notional income. Is that okay? Already I explained that 100 flats were constructed, 50 sold, another 20 booked, supposed to be saleable. 30 remains unsaleable. Even that remains unsaleable status for more than 2 years, then second after the third year, so from the beginning of third years, for all the 30 houses, you have to find out the income from house property deemed to be let out basis, and you have to pay the tax on that. Is that clear? So up to 2 years, nothing will be taxable. So annual value is nil for up to 2 years. After the financial year in which the completion certificate is obtained, once the flat is constructed completely and got the certification that it got completed for living purpose, from the date 2 years will be allowed to retain without any problem. Beyond the 2 years, then it will be considered as deemed to be let out only. Okay, condition: the property must be held as a stock in trade. It's applicable only for the builders. Okay, so we purchase the house properties only as a property asset, but the builders, they will purchase and sell as a trading item here. So for them it is a stock in trade. If that property is held as a stock in trade and not let out for the 2 years, nothing is taxable. Beyond 2 years, automatically it becomes taxable. Objectives: encourage construction activity and offers tax relief to builders holding unsold inventory. That's the logic behind. Clear? This is available only for the builders case. Now, Section 25A. Section 25A. Unrealized rent or arrear rent, whatever it may be. So you can claim the deductions for the unrealized rent if the condition given in rule number 4 is satisfied. From the annual rent, you can subtract the unrealized rent. Few years later, that unrealized rent is recovered. What can we do? In the year of recovery, from that value, straight away deduct 30%, its balance will be taxable. So, 2021, in that year, we have an unrealized rent of rupees 1 lakh. And we claim this deduction as the condition laid in rule number 4 is satisfied. In the previous year, 24-25, out of that, 60,000 is received. What about the taxability of this, sir? Nothing. Straight away deduct 24,000 rupees from here, balance 36,000 is taxable. This deduction as per section 25A. Section 25A. Is that clear? Amount realized minus 30%. Not the full value. Any amount realized, no, from that 30% is subtracted. Come on, try this illustration. Mr. Lal is the owner of commercial property let out for 60,000 per month. Okay, then this is annual rent. 16 to 12, 7 lakhs 20,000 rupees. Corporation tax 30,000 rupees, municipal tax. 60% which is payable by the tenant. Out of that 60% payable, then you can claim only 40% of that. Okay. The tax was actually paid after 31st March. So two conditions should be satisfied. One is it should be paid, that too by the owner. Paid means it should be paid within the due date, within 31st March itself. Okay. So we have three different dates here for the payment. One is all about within the end of the same year, 31st March. Another two more cases we will study along with the PGBP where the date may be pretty extended. Okay. So in the case of municipal tax is considered as paid only if it is paid within the year end, 31st March. Some cases in PGBP will study, paid means you can pay within the due date of filing of return of income. For the 31st March 2025, the financial year ends, no. For that, any payment pending, you can pay this before the due date of filing of the return of income. Usually, the filing of return of income happens on 31st July. So before 31st July, if you make the payment, it is assumed to be the payment. But in case of municipal tax, the payment should mean only if the payment is made within 31st March of the same financial year, previous year. So nothing is deductible. You forget about this. He had borrowed a sum of rupees 40 lakhs from his cousin, resident in Singapore in dollars. Right. For the construction of the property on which 8% is payable. So he borrowed the money only for the specific purpose of construction of this. So stating that I borrowed only for the construction purpose, of course you can consider this for the deduction purpose. You need to get the certificate that the expenses is for the house property income only, right? If you are making any payment outside India, because you are borrowing it from your cousin who is residing in outside India. If you are making any payment outside India, automatically TDS will be applicable. TDS will be applicable. We'll study the TDS concept in detail along with the PGBP chapter. So if the TDS is missing, you cannot claim the deduction. Okay. He also received arrear of rent. So here rent received being how much? 7,20,000 rupees. That rent received is considered as GAV. We don't have any other information. From that you can subtract what? Municipal tax. Nothing is there. So NAV being 7,20,000 rupees minus standard deduction under section 24 class A. How much is that? 30% on this. Come on, make it faster. 2,16,000, and you can now claim for interest expenses under section 24 class B. So the loan being 40 lakhs multiplied with 8%, the value being 3,20,000. If you are making any payment outside India, remember TDS should be there. We assume TDS is deducted and deposited. Okay, that you have to be careful with this. So now the taxable income from house property being 1,84,000. What happens, sir, in case of arrear rent? He also received arrears of rent rupees 80,000 in the same year, which was not charged to tax in the earlier year. Due to the satisfaction of the rule number 4 conditions, we claim the deductions from the annual rent. As it was not charged earlier, on recovery of that, automatically it's taxable, but you can subtract 30%, balance will be taxable. Okay, so arrear rent. The value being 80,000 rupees minus deduction 24,000. So 56,000 will be the taxable value. Overall income from house property in this case being both value put together 2,40,000. Clear? Under section 25, this one is section 25. If you are supposed to pay interest outside India, TDS should be deducted. Only then you can claim the deductions. We assume that here the TDS is promptly deducted and legal compliances met properly. So we can claim the deductions also. Clear? So we have completed what? Section 22, chargeability, charging section over. Calculation of NAV under section 23 class 1 over. Calculation of NAV. NAV is nil in case of self-occupied property, section 23 class 2. And what happens in case part of the year let out and part of the year self-occupied? We have to discuss. And deemed to be let out in case if you are holding more than 2 house property, we already studied. Newly constructed properties, their annual value is nil under section 23 class 5, we have studied. And section 24 class A is all about standard deduction. Section 24 class B is all about deductions for the interest on loan borrowed for construction of house property. Section 25 I just now incorporated here. Interest without TDS paid outside India, not deductible from the income from house property. So in this illustration, we are supposed to pay the interest to his cousin in Singapore. As the payment goes outside India, it can be deductible only if the TDS is deducted. But the status of deductibility of TDS is missing. We assume it may be deducted. So the legal provisions under section 25 is met. So we deduct it. Section 25A is all about treatment of unrealized rent and arrear rent in case of receipt. What are the amount you receive for the unrealized rent of the previous year or arrear rent? Straight away 30% deducted, balance will be taxable. So we now need to complete 23 class 3 and property owned by 2 owners, co-owners. If you calculate these two, if you complete these two, then entire content will be over. Okay. 27th is the theory. In case of let out, we have what? Time wise let out partly, area wise, and we may have time as well as area wise. Clear? So once we complete, this one will be totally over. So these are the sections 22 to 27 we need to cover under income from house property chapter. Clear? Yes. Come on, try this. Let out part of the year and self-occupied the other part of the year. In this case, actual rent excludes self-occupied part, time-wise division. Okay, it means annual rent minus self-occupied period will be removed, or rent for the self-occupied period will be removed. Treat like unrealized rent. Treat like unrealized rent, but it's not unrealized rent, right? You occupied, right? Mr. X lets his house property on 1/4/24 to 31st December 24 at a monthly rent of 7,000 from the next day onwards to the year end it was self-occupied. How many months are there? 9 months is means let out. 3 months are for self-occupancy purpose. Other relevant data are there. So municipal value, come on, rest of the things are the same way. Municipal value being 90. Okay, municipal value 90. And fair rent 80. Whichever is higher will be taken 90. Standard rent 60. Whichever is lower will be taken 60. This is expected rent. Rent received. You have received only for 9 months at the rate of 7,000 rupees. How much is that? 63,000. Between these two, whichever is higher will be taken. So 63,000 being GAV. From there, you can subtract the municipal tax at the rate of 15% on the municipal value 13,500. 13,500. Am I right? So your NAV being 49,500. You can claim the standard deduction under section 24 class A. 30% being 14,850 and interest on loan being 12,000 rupees. Section 24 class B. Of course, you can subtract these two to find out the income from house property. 22,650. So the intricate calculations related to the interest and loan calculation maximum may not be available in the case of comprehensive illustration. Directly interest on loan may be given. If the interest on loan given after segregating that to pre and post, the pre-construction period interest will be amortized over 5 years period. Post-construction period interest you can straight away subtract. Clear? Yeah, come on, make a note of it. We are dealing with section 23 class 3. Now, let's move on to the next one. Clear? Online students, come on, respond. Make it faster. Yeah. Next. Let out of the property unit 1 and self occupied the other part of the property, another unit, area wise division. Self occupied property, no, that division you can treat like self occupancy. Let out, you just calculate like let out, that's all. Segregate and proceed with the normal procedure here. Miss Singer has a house property having two separate residential unit. Unit A covering 40% of the total area and Unit B covering 60% of the total area. Okay, Unit A. Okay, what is the area covered? 40%. Unit A is self-occupied. The status of this one being self-occupied. Unit B, which is covering 60% of area. Okay, which is let out to Sri Raj for a monthly rent of 3,000 rupees. Let out. Monthly rent of 3,000 rupees. With the following further information, compute her taxable income from the house property. In case of Unit A, as it is being self-occupied, NAV is equal to 0. From there, you can subtract only the interest. Interest on loan being 30,000 rupees, for that self-occupied portion as well as let out classification will be done. 40%, 12,000 is for the self-occupancy, 18,000 for the let out. So 12,000 can be subtracted from 0, so you'll get 12,000 negative in case of self-occupied portion. Okay, in case of let out, you have to take the municipal value, fair rent, standard rent. Municipal value. This 1 lakh is for the full house property. But let out portion covers only 60%, means you have to take only 60% of all these values. So municipal value is 60. Fair value, how much? 72. Between these two, whichever is higher, 72. And standard rent, 1,20,000 rupees. Between these two, whichever is lower will be taken. That is what about expected rent, 72,000. And rent received, 3,000 per month for 12 months, 36,000. Between these two, whichever is higher will be taken. 72 will be gross annual value minus municipal tax. Municipal tax being 10% on the occupied portion, let out portion. For 60, 10% being 6,000. Your NAV being 66,000 minus standard deduction under section 24 class A, 30% on this. How much? 19,800. You can subtract the interest component. Interest component being 18,000 for this let out portion alone. Then overall income from house property for let out, 28,200. And income from house property being, you adjust these two, how much is that? 16,200. 16,200 will be the income from house property. In one unit you have loss, another unit you have profit, so you can merge both the things, so that you will end up with 16,200 being the income from house property. Clear? Now let's move on to the next illustration. One of the comprehensive illustrations asked in the exam. Area and time-wise division both are available here. Mr. A and B constructed their houses on a piece land purchased by them at New Delhi. The build-up area of each house was 1000 square feet, ground floor, and an equal area in the first floor. Is that okay? Ground floor and first floor. A started construction on 1/4/23 and completed on 31/3/24. So 1/4/23 and 31/3/24. Now we are calculating the income from house property from 24 to 25. So then this period is considered as a construction period, pre-construction period. B started the construction on 1/4/23 and completed the construction on this date. Let me first finish up calculating A alone. Thereafter, I will go for B separately. So B part I am not going to consider now. Mr. A occupied the entire house on 1/4/24. 1/4/24 onwards, it is self-occupied. This is for the construction period. From this date onwards, it started occupied. B occupied, will skip that. Okay. Clear? So 31st March 25. Construction completed here, then it is self-occupied thereafter completely by A. So as A is not let out, the entire year it is for self-occupancy purpose. You can now calculate the NAV assuming 0. From there you can claim only interest deduction. Okay. Fair rent not matter, municipal value, municipal tax, repairs usually will not be taken. A has availed the housing loan 20 lakhs at the rate of 12% per annum on 1/4/23. On this date itself, the loan is borrowed 20 lakhs. B has availed the housing loan. You forget about B. No repayment was made by either of them till this date. So A or B, both not repaid the loan. So for this 20 lakhs at the rate of 12%, for this period 1/4/23 to 31st March 24 is called pre-construction period. For the pre-construction period, interest is only 1 year. That interest here being 2,40,000. Am I right? Thereafter also it remains unpaid. So 20 lakhs into 12% on this period being 2,40,000. Now how much interest can be deductible in case of pre-construction period? 1/5 of the value can be deductible. 1/5 of the value. 1/5 of the value being how much? 48,000. Post construction period interest, you can straight away deduct full value 2,40,000. From the 0, if you subtract these two, but anyhow these two put together, maximum how much could be here? Only 2 lakhs. So 2 lakhs will be the maximum loss here. Clear? Income from house property. In case of self-occupancy, the maximum interest deductible is only 2 lakhs. Pre-construction period interest 48, post-construction period interest is 2,40,000, total 288, but anyhow restricted to only 2 lakhs. It is being the self-occupancy. If it is being let out, you can claim the full value. Okay. So I am going to solve the illustration in B's view. Okay. B started construction on 1/4/23, completed construction on 36/24. Then what about the pre-construction period? from the date of starting the construction 1/4/23, and ending date will be the construction completed by this date, but earlier 31st March will be taken if the loan is not repaid. So 31st March 24 will be taken. Okay, this will be the pre-construction period. Mr. A occupied, that you can leave it. B occupied the ground floor okay on 1/7/24, self-occupied, and let out the first floor for a rent of rupees 15,000 per month. Okay, 1/7/24 onwards. Clear. However, the tenant vacated the house. So 1/7/24 onwards it was let out. Up to 31/12/24 it was let out. Thereafter, okay, B occupied the entire house during the period from this date. Remaining date self-occupied. Remaining date being self-occupied. Now, no other way, you have to segregate these two houses. In case of self-occupied portion, NAV is equal to 0. From there, you can subtract only the interest. You'll get income from house property here. In case of let out portion, take with the fair rent, ground floor and first floor, each unit costing rupees 1 lakh. But the house property anyhow got ready on only 1/7/24, means hereafter you have to calculate from the date to the year, 1/7/24 to 31st March 25. From here to here, how many months are there? 9 months. So the let out is going to be calculated only for the 9 months. Sir, out of the 9 months, 3 months self-occupied, sir. No, in case of self-occupied, that will be considered as unrealized rent like. It's not unrealized rent, but you have to treat that same unrealized rent logic here. So fair rent being 1 lakh for 9 months, 9/12, it's 75,000. Fair rent. Municipal value 72,000 into 9 months only you have to calculate, which is 54,000. Between these two, whichever is higher will be taken. Of course, standard rent is not given there. No standard rent information. So then it itself being the expected rate. Now rent received. Rent received being, of course, repairs will not be taken. So rent received being 15,000. 15,000 for how many months they have received? Only for 6 months. Sir, 9 months, sir. 9 months out of that, 3 months is self-occupied. That self-occupied portion, rent is excluded, but calculation is for the 9 months. So 15 into 9, 90,000 rupees will be the value here. Between these two, whichever is higher will be taken. Whichever is higher. This will be the GAV. GAV in this case being 90,000. Right. From there, you can subtract the municipal tax. Municipal tax paid by A, not a matter, that is not deductible. For B, of course, it can be deductible, 8,000 rupees. 8,000 is for the whole house. Nothing stated, no. We assume this is for the full house property. For the 50% share, it may be 4,000. So, your NAV being 86,000 minus standard deduction 30%. 30% being 25,800. 25,800. And then you have to subtract the interest. Anyhow, the repairs and maintenance could not be taken anyway. For the interest calculation, come on. B has availed a housing loan of 12 lakhs at the rate of 10% on which date? 1/7/23. Though the construction started on 1/4/23, the loan availed date is only 1/7/23. So commencement of construction or loan availing date, whichever is later will be taken. So 1/7/23 will be taken. Pre-construction period end date will be the repayment date or 31st, earliest to 31st date, 31st March from the year of completion. So between this period will be considered as pre-construction period. So for the 12 lakhs, 10% for how many months? From here to here, 9 months. So 9 months. So 9 by 12. What is the value? 45,000. 10% for 9 months. 90,000. Okay, 90,000. This is pre-construction. Similarly, for post-construction period, 12 lakhs into 10%, the entire loan remains unpaid. So 1,20,000. 1,20,000 rupees. In case of pre-construction period, you are eligible for claiming only 1/5. 1/5 being 18,000. So overall interest claimable being 1,38,000 for the entire house. This will be now segregated for the ground floor as well as first floor. 50-50 each. Ground floor rate being 69,000. Am I right? And for first floor, 69. For ground floor, maximum 2 lakhs you can deduct. So it's within the limit. For the first floor, no limit you can deduct because it's a let out. Now, come on, find out the value here. You subtract these two. This one is 8,800 negative. Here 69,000 negative. Ultimate value being 77,000 800 negative income from house property. In case of B. In case of A, we have 2 lakhs loss. In case of B, 77,800 being the loss. Is that clear? Come on, make a note of it. So we have completed realization of arrear of rent and real estate concept completed. Now we move on to the co-owners composite rent. Let me finish up co-owners case first. This will be as per section 26. Section 26. Okay. In case of co-owners, the property is owned by 2 or 3 members. You can calculate as usual. Finally, you can share as per their ratio. That's all. Calculate income from house property as usual case. If the property is owned by 2 owners, based on their own sharing ratio, probably 3:2, then the income from house property will be shared between these two. Income includes loss also. In case of loss, that loss will also be shared in the same ratio. Those loss will be set off in their own other income. Okay. But in case of self-occupancy purpose, the limit 30,000 or 20,000, 2 lakhs, no, for the interest calculation. If the property is owned by 3 owners, then 30 will be multiplied with the 3. 90,000 rupees can be deductible. In case of higher limit, 2 lakhs is applicable, then 2 lakhs into 3, 6 lakhs can be deductible. Only this will be different, rest will be the same. Okay, calculate as usual, and house property income is shared among the co-owners. In case of self-occupied, the interest limit is multiplied by the number of co-owners. That's all. See, it's one of the easiest illustrations. Mr. Raman is a co-owner of a house property along with his brother. Municipal value of the property 160, fair rent and standard rent also given, rent received is there. So it is owned by Raman and his brother. So municipal value 1,60,000, fair rent 1,50,000. Between these two, whichever is higher will be taken. and standard rent 1,70,000. Between these two, whichever is lower will be taken, which is the estimated rent 1,60,000. Then rent received 15,000 per month. Let's see, is there any unreleased rent or vacancy allowance? The loan for the construction of this property is jointly taken, and then interest charged by the bank is 25,000. 25,000 is the interest, out of which 21,000 has been paid. 21,000 interest paid. Interest on unpaid interest. So on the due date, they have not paid the loan. As they are not repaid, they again charge the interest on the accrued interest. Interest on interest, which is 450. Interest on interest. To repay this loan, Raman and his brother have taken a fresh loan, and interest charge on this loan being 5,000 rupees. Apart from that, they have paid another 5,000 rupees. Okay, another 5,000 rupees. What about this? This is the interest payable on fresh loan for what? For repayment of housing loan, repayment of home loan. Municipal tax 5,100 have been paid by tenant, so it is not deductible. Okay. Now, what amount can be deductible? Okay. Out of 25,000, I think it is not this way classification. 21,000 paid, 4,000 is unpaid. Unpaid. Okay. Out of the 5,000 rupees, 21,000 paid, balance not paid. This one is different and this one is different. So, 3 informations given. Okay. What are the interests can be deductible? Whether paid or unpaid, not problem. You can claim the deduction. Paid also be deductible and unpaid also be deductible. Interest on fresh loan for repaying the housing loan. So, original house loan is also housing loan. Repaying that, he has taken one more loan. This new loan is to repay the housing loan only. No. So, in that case, that interest also be eligible for claiming the deduction. But in this case, this interest is paid for delayed settlement of the loan. Interest on interest. Interest on interest is not housing loan, right? So, this is not eligible for claiming the deductions. Only these 3 can be claimable. How much? 30,000 rupees. 30,000 can be deductible here. Now, rent received being how much? 15,000 rupees per month. 15,000 per month for 12 months, 1,80,000. Between these two, whichever is higher will be taken. GAV, 1,80,000. Municipal tax cannot be deductible. NAV. And of course, you can subtract what? Standard deduction 30%. 54,000. And interest can also be deductible. Value being 30,000. 421 plus 5, 30,000 can be deductible. Municipal tax case only the payment is must. In this case, payment is not a matter. So, 84,000 can be deductible. So, 96,000 will be the taxable income from house property. But it is owned by 2, right? Raman and his brother. As the sharing ratio is not given, we assume both the owners are having equal rights. 48,000 will be the taxable income in the hands of Raman. Another 48,000 will be taxable income in the hands of his brother. Clear? Hope now you will be able to understand. So, for the clarification, what are the interests can be deductible? I have given a list. Finish up copying this. Let me discuss that one now. Make it faster. Clear? Text me. Now, so in the interest calculations, here is a note. Interest is deductible in due basis also, not necessary that it might have been paid. And the loan should be taken from either banks, financial institution, friends and family also be allowed. Okay, but in case for any payment arranging the loan, like brokerage, commission for arranging loan, no deduction is allowable. No deduction is allowable. Fresh loan taken to repay the original home loan, deductible. That we have seen in this illustration. Original loan was closed by taking the fresh loan. Okay, because initially they may get the loan from some private sector banks where the rate of interest is higher. Then later they simply move on to the nationalist bank. So they borrow the loan from the nationalist bank to close the private bank's interest. Okay, they're due. In that case, any interest payable for the nationalist bank will also be eligible for the deduction. Right. Interest on loan for unpaid interest. So in installment, during the installment period, you fail to pay. Okay, because of that, interest carries on interest also. Again, interest carries are added on the interest, accumulated interest, unpaid interest. That will not be deductible because it's not housing loan. It's not housing loan. Now, section 25 is nothing but if the interest is payable outside India, that can be deductible only if TDS is deducted. TDS is deducted. Then one more point, buyer and seller. Buyer and seller. B purchases the house property from seller, residential house property, the value being 100 lakhs. B has made a payment of rupees 60 lakhs. Balance 40 lakhs remains unpaid. Balance 40 lakhs remains unpaid. So while calculating the income from house property of B, NAV being some value minus interest. What about the interest? For the 40 lakhs, B said, I will pay a bit late along with interest. If any interest, say at the rate of 10% is payable, 4 lakhs, that 4 lakhs can be subtracted here. Is that okay? Unpaid purchase price will be considered as borrowing. The full value is 100, but you paid only 60. This 40 rupees, no, is called unpaid purchase price. If unpaid purchase price carries any interest, that interest can also be deductible. Interest paid to seller is also be deductible. Hope you will be now able to understand the complete structure of interest calculation and deductions availability for that. Clear? Now, the last component, co-owner is over. Composite rent. Composite rent. Okay. So composite rent is nothing but where A lets out his property to B. Okay. Residential house property. For that, B accepts to pay 25,000 as rent per month. But in the A's residential house property, no, it's fully furnished. So most of the cases, no, in foreign countries especially. Nowadays, it may be available in India also. So he purchased the house property, fixed the AC and modular kitchen and TV, everything, washing machine, everything set. Suddenly, because of his job requirement, he may be transferred to some other location. He may be back only after 3 to 4 years. So he wants to let out that property. If he wants to let out, what happens to all this equipment? He cannot transfer that to the new place. So he simply allows the tenant to use that for an additional payment. So now what happens? Residential house property along with the furniture also given to B. 25,000 for the residential house property, and for furniture another 10,000 is also offered per month basis. Clear? In this case, A's intention is to let out only residential house property. Because of non-availability of proper source of saving this furniture, he has let out that one also. It is not his regular income, regular job. As it is not his regular job, any income derived for this purpose, segregated separately, and for this segregated separately, this will fall under income from house property. Income from house property. This will be called as income from other sources. Why such classification is must, sir? The proper classification will give you some good deduction also. If you classify the income from other sources as income from house property, you can claim 30% flat for the standard deduction. It's a cheating like. Okay, if you are considering the income from house property as being the income from other sources, you are losing that 30% deduction. That 30% standard deduction under section 24 class A is available only in the case of income from house property, not for income from other sources. So proper classification is must. Instead of this scenario, we'll assume the other scenario. A has multiple buildings. His nature of business is letting out, and letting out his is the primary job for him. So he let out his own residential house property for B, and he gets rupees 25,000 per month for the property. And B gets transferred from some other location to here, may stay here for a couple of years only. So he wants all the furnitures. He demands A to provide those furnitures also for an additional rent. A says, no problem, sir. I have already 10 houses, and I will provide the furnitures also along with these houses whenever they are in need. If you want the furniture, I am willing to provide the furniture also. For the furniture, you have to pay me 10,000 rupees per month additionally. Okay. Furniture means it may be AC, refrigerator, TV, and washing machine, and all these things put together. Now, A not only letting out the house property as his own regular business, and he has the furnitures and other things also letting out as his own business nature. So you might have seen for the functions and the marriage, for the emergency, air cooler and blower, everything may be taken in rental. This in this case, A giving all these things as a rental business for somebody, it's a business. Then this 10,000 will be classifiable as what? PGBP. This will be income from house property. Is that clear? Hope you will be now able to understand. So here rental is not only for the house property, it may be for other furnitures or other facilities also. Sometimes you see A lets out his residential property to B, residential house property for B. But along with the furniture, and B makes a payment of rupees 40,000 rupees. Now, the question arises, will A be letting the residential house property alone separately? Yes, sir, possible. Will it be possible to let out furniture separately? Yes, possible. So you can separate it, yes or no. Yes, sir. Yes, sir means you have to segregate residential house property let out separately and taxed under income from house property. Other will be treated as either income from other sources or PGBP. No, sir. Letting out the residential house property and furniture separately, not possible. Here the value seems to be collectively given, not segregated for the house property and furniture separately, but possible. Letting out of the residential house property may be separately, furniture may be separately. If it is so, it's your duty to segregate that 40,000 for the residential house property separately, the other sources or business separately and treat accordingly. No, sir, I cannot let out separately. You need to take as it is. You might have seen lots of service apartment here. Now it's a booming business in many of the locality. Okay, serviced apartment. Not only residential house property, kitchen and bedroom with bed and all facilities may be given. And in the hall, living, they will give the furnitures also. Okay, you may get for rental also. Per day rent, it's around 1,500 or 2,000 rupees. Rather than restaurant, serviced apartments is there. Seems to be a restaurant like. Sir, we offer together with that, sir, we cannot segregate. It's not possible to segregate, sir. We quote the price collectively. Then question arises. Are you doing this as a business or now and then rarely? If you are doing now and then rarely, then it is falling under income from other sources. No, sir. This service apartment concept is designed. I am doing it seriously as a business. Then it will come under PGBP. PGBP. Right. So the question is separabilities matter. If the letting out of these property separately, then separable, then it is separable. In case of it is separable, then separate that for the residential house property and for the others. For the residential house property, it will be taxed under income from other sources. Others may be taxable in the head of income from other sources or PGBP. So separability is not in billing. Here the billing is separately given. Here the billing is collectively given. Collectively given is not mean so that it is not separable. If it is collectively given, there is a possibility to let out the property separately and other facilities separately. Then you have to treat it separately only. No, sir, that is not possible. Then it will be handled the other way. Inseparable case. This is separable case. This is inseparable case. Sometimes restaurants. When you go to some travel in the national highway, you have seen so many restaurants, right? So the national highway, when it was established very beginning, no, I could still remember I started driving to Chennai and here, shuttling between Trichy and Chennai by car from 2012 onwards. At least monthly twice I used to go by car by the time. Okay, only coffee shops will be there. And that to Kumbakonam degree coffee. Trichy to Chennai. But now, no Kumbakonam degree coffee is there. Big restaurants were there. Throughout, the first time I see massive structured restaurant, next time that entire business is collapsed. The new business comes. I have seen one particular restaurant named 3 different owners, sometimes 3. Okay, 3 different owners, especially in Ulundurpet as well as here in Vilupuram and Vikravandi toll. It's horrible to park the vehicle. So much of crowded. The national highway is to drive smoothly, but because of this much of shops, no. Okay, that too, especially biryani shops. The entire parking overflowed and started parking in the national highway itself. I could still remember once I was very tired. So, overnight drive from Chennai to Trichy, returning by around 2:30, 3 o'clock. It seems to be a manad like in a place. Then I, very slow driving to see what's happening. Then it's a Kombapatti biryani. I just hear, I've not seen Kombapatti biryani anywhere. So, that's a place. I got totally stunned. Now what happens now, we started a restaurant. That entire restaurant, the building is furnished pakka for the restaurant purpose. Okay, the kitchen and all the things. Suddenly I cannot run the business. I want to rent out, at least let out to somebody else. The other person comes and uses this for the hotel purpose only. Now I am letting out the entire property along with a pre-structured setup for running the hotel industry only. Now what happens here? This is not let out of house property. It's nothing but income from other sources of PGB. Even cinema theaters, factories, also building. But I cannot let out the building alone separately because I invested. All the things are prefixed. Now I am able to let out along with these two. It's not possible to segregate. In those cases, that rental income may be either PGBP income or income from other sources as the case may be. Composite rent, combined receipt of land and building. Okay, land and building, and other assets like furniture, plant and machinery, and sometimes in apartments, lift, securities, power also be given. All the facilities are given, and the overall value being 40,000 rupees. Now the question is it possible to segregate, sir? Yes, sir. For the land and building, it is 25,000. For furniture fixtures, 10,000. For securities and lift service, 5,000 rupees. If I am able to segregate, separable, this will be income from other source, house property. These two are considered as either PGBP or income from other sources. Either it may be named as PGBP or income from house property. No, sir, there is no such provisions. As just now explained, in case of restaurant, I could not run. I am letting out the restaurant to the another restaurant with full setup. Okay, even I am running a factory. I am letting out the factory with full setup with the plant and machinery. In that case, it is not possible to let out. Then this will not come under income from house property. It may be either named as PGBP or income from other sources. This is what about the separable and non-separable cases. Composite rent. Separable means capable to let out separately. Capable to let out separately. It's not building separately. Okay, it's not billing separately. You can give the billing collectively, but if you are able to let out separately building and other things, then no problem. That will be considered as separable only. That combined bill will be segregated somehow, reasonably. Yeah. To understand, we'll try to solve this illustration. Composite rent separable. Mr. Kalidas is the owner of a house property. Its municipal valuation 7 lakhs and let out for 9 lakhs. The local tax payable by the owner is 40,000. But as per the agreement between tenant and landlord, the tenant has paid them directly. So the municipal taxes paid by the tenant should not be considered for the deduction purpose. The landlord, however, bears the following expenses. So rent received being 9 lakhs and 9 lakhs for residential house property, for other facility as well as provisions of means any asset. Okay, probably furniture and all. So 9 lakhs collected by the landlord, and not only residential house property, gives some other support also. Expenses of water connection. Expenses of water connection is a capital receipt. Usually it will not be income. Don't forget about that. So remove that. So now the owner provides water charges 5,000 rupees. Lift maintenance, water, and provides lift service also. It costs us 10,000 rupees. Salary to gardener, okay. This value being 36,000. Lighting of stairs, lighting, the value being 15,000. Maintenance of swimming pool in flats, no. The common association may collect the maintenance charges to provide lots of maintenance and other support services. Here swimming pool also be provided. For that there is a charges around rupees 20,000. The landlord claims the following deduction from his income. Repair cannot be claimable. This is not claimable. This is not claimable. For that standard deduction, 30% will be given straight away. Nothing can be deductible. Isn't it? So the support given by the owner to the tenant being these items. This is capital expenditure will not be considered. Capital expenditure will not be considered. Come on, total this value 86,000. Out of 9 lakhs collection, 86,000 is for this facility. Balance will be for the rental, means house properties rental, 8 lakhs 14,000. Now come on, calculate. Expected rent being municipal value 7 lakhs and rent received being 8 lakhs 14 only. This will fall under income from other sources. If he spends 80,000 rupees for provision of these services, remaining 6,000 will be considered as income from other sources. That will be separate. Now, GAV being whichever is higher of these two, 8 lakhs 14,000. Municipal tax cannot be deductible as this is paid by the tenant he himself, nothing is deductible. So NAV being 8 lakhs 14,000 minus Standard deduction at the rate of 24%. Sorry, 30%. Come on. 2 lakhs 44,200. Then finally, income from house property being 5 lakhs 69,800. Clear? This is what about the separability concept. Separability concept. Clear? Clear? Make it faster. Now, see rule number 115. When you have your house property outside India, of course, if you are being ROR, it's going to be taxable only in India, right? But by the time the revenue may be in foreign currency, that should be converted into Indian currency. To convert that, what rate should be taken? TT buying rate on the last day of the previous year will be taken. Telegraphic transfer buying rate. So when you go and see the rates quoted for the dollar by the banker, right? So this rate may be 84 rupees, 84 rupees, 20 paise like. This is what about the buying rate, bid rate. This is what about ask rate. If you want to sell your dollar, banker will take it for 84 rupees. If you want to buy the dollar, banker will charge this much. The difference between these two is the gain for the bankers for this service, right? So if you plan to go for foreign country, you need dollar. So while asking the dollar to be purchased from the banker demands 84 rupees 25 say per dollar. So if you are bringing the dollar from foreign country, you want to sell this, then the banker will take it at only 84. So this is what about the bid rate or buying rate in the point of view of the company, means the trader. So you have $100 revenue for letting out purpose. To convert that to Indian rupees, $100 is converted into bid rate here or buying rate here. So 8,400 will be your rental income. Is that clear? That too, the rate as on the last date of the financial year. Last date of the financial year. This is what about the rule you have to follow. Rule number 115. Is that clear? It's a very rare. It's very rare, but anyhow, you just keep this in your mind. For that, now let's try to solve this illustration here. This illustration seems to be pretty massive and very complicated when it was really asked in the examination. Okay, but now it becomes very easy because when it was asked to know, only one house property can be considered as self-occupied if you are holding more than 2 house property, 3 house properties. For self-occupancy purpose, only one will be considered as self-occupancy, balance 2 will be considered as deemed to be let out. Okay, the latest two years onwards, 2 house properties can be considered for your self-occupancy. Beyond that, only deemed to be let out. In this illustration, 2 house properties are there, so you can enjoy 2 house properties being the self-occupied. So the sum becomes easy because NAV itself 0, only interest is deductible, right? So that's why this sum seems to be now easy, but anyhow, it is still available in CA Institute material. So I am guiding this one here. Mrs. Rohini Ravi, citizen of USA, is an ROR in India. So if The assessee being ROR, the global income will be taxable. Not only Indian income, foreign income is also taxable. During the financial year 24-25, she owns house property at Los Angeles, USA, which is used as her residence. Okay, she won. Okay, the annual value of the house being $20,000. The value of US dollar may be taken as 45 by the time. Anyhow, this is self occupancy. Self occupancy. So Los Angeles. Okay, this is self occupancy. Self occupancy means NAV itself 0. She took ownership and possession of a flat in Chennai 1724, which is used for self occupation while she is in Trichy, in India. In India, also, she has one more house property that is also used for self occupancy. Right. The flat used by her for 7 months only during the previous year, 31/3/2025, while the municipal valuation 32,000, fair rent 4,20,000, and she paid the following corporation taxes. Anyhow, NAV being 0. So earlier it was the toughest question because one of these two will be considered as deemed to be let out only because only one allowed. Now two house properties are allowed for self occupancy. So both will be considered for the self occupancy means NAV is 0 directly. And from there you can claim only one deduction is interest. Okay. She had taken a loan for purchasing this flat. Interest on loan was this much. Okay. When she completes the purchase 1724, then pre-construction period ends on which date? 31st March 24. Up to this is called pre-construction period. Thereafter it is post-construction period. Prior period to 1424. Okay, up to this period, this is called pre-construction period. 1424 and up to the date of construction. After the construction, up to the year end, these two will be considered what? Post-construction only. To confuse you, this term is used. When you acquire or when you complete the construction, pre-construction period ends earliest to 31st March in the year of construction. In the year of construction, the construction completed on 31st. When 1st July. 1st July means earliest to 31st March being 31st March 2024. Up to that date will be pre-construction period. Thereafter, it's a post-construction period. So this will be 49,200. This will be, come on, 1,82,100. She had a house property. She had earlier house property in Bangalore, which was sold some years ago. March 2022 itself, it was sold. In respect of this house, she received arrears of rent rupees 60,000 in March. If there is any arrear rent, what happens then? Section 25A will be applicable. As per that, whatever the rent you receive, flat 30% is deducted, balance will be taxable. Okay. How much is that? 42,000 will be the taxable income from house property. This amount has not been charged to tax earlier. So earlier we claimed the deductions, now we are receiving, so it should be taxable after is flat deductions of 30%. Compute the income chargeable from house property of Mrs. Rohini Ravi for the assessment year 25-25. 25-26 exercise the most beneficial option. So this sum becomes now easier. Okay. Now interest. This one can be claimable only 1/5. 1/5 is how much? Come on. 9,000. You can add up these two. How much is you can claim now? 1 lakh. Maximum 2 lakhs can be claimable. So you can claim this entire value here minus interest. 1,91,940. For the Los Angeles house property 0. For the property in India 1,91,940 being loss. For all the three property put together, what about the income from house property? Come on, tell me. 1,91,940 negative, 42,000 positive, 0 for Los Angeles house. 1,49,940 will be the taxable income from house property. Clear? So we have completed all the illustrations. One more illustration for understanding the concept, very small illustration also given. Thereafter, a few one word questions like discussion purpose, and left with only one section, section 27, for the better understanding. Okay, deemed one. Okay, clear? Now, Miss Anjali owns house property which is let out to her employer. Already I explained this, right? Miss Anjali. So she gives her residential house property to employer for a monthly rent of rupees 20,000. The company allotted the same to Mrs. A as rent-free accommodation. And municipal tax 20,000, interest on loan paid 90,000. Comment and tax treatment. Though Miss A resides in her own home, but not being the owner capacity, being the employee capacity, she resides. So then automatically income from house property will be applicable here. So GAV being 20,000 rupees per month into 12 months, 2,40,000, minus municipal tax should be subtracted 20,000 rupees. I assume it is paid by Miss A herself. So 2,20,000 being NAV, minus standard deduction 30%, 66,000. Apart from that, interest is also be deductible. There is no any limit for this. As it's treated as let out, 90,000 can be deductible. So taxable income from house property being, come on, 64,000. Not only that, this is income from house property. And for Miss A, it is taxable as salary also. Am I right? Rent-free accommodation. How much? 5%, 7.5% or 10% of the salary will be considered as perquisite's value, right? Okay, maybe if she lives in Chennai, 10% of salary will be considered for taxable under salary head also. Dual taxation. One is for letting out of the property, next one is she was provided the rent-free accommodation from the employer, so it is a perquisite under section 17 class 2. Okay, 17 class 2, subclass 1 and 1, 2. Okay, clear? Now, some theory. Discuss in case of the following issue relating to the income from house property. Income earned by residents from house property situated in foreign country. Is it taxable? Yes. If you are being ROR, if you have the house property within India or outside India, doesn't matter, you have to pay the tax on income from house property. Properties which are used for agricultural purpose. If it is used for agricultural purpose, it's an agricultural income, completely exempted. Okay. House property with the disputed ownership, still taxable in the hands of the deemed owner, beneficial owner. Okay. For example, residential house property is held by Mr. A. Mr. B claimed that this house property is his own property in the court. Now, the dispute is between Mr. A and B in the court. Currently, Mr. A possesses and lets out this to Mr. X. And Mr. X gives the rent to Mr. A. Now, who has to pay the tax? Until the dispute is settled, currently the benefits enjoyed by whom? Mr. A only, no. So, he has to pay the tax on this. So, in case of disputed ownership, who has to pay the tax? So, only the person who is enjoying, the beneficial owner, who is called beneficial owner and deemed owner. So, that we'll study under section 27, the last one. Okay. Taxable in the hands of the beneficial owner. Clear? Next. SSA Limited has 2 house properties and claims benefit of self-occupied property for the same. Discuss the applicability. 2 house properties. Who's that? SSA Limited. This 2 house property residential status means self-occupied benefit can be enjoyable only for the individual and half. Right. Individual only needs the house to live. Right. I cannot say the evening at 5 o'clock, Singer Academy will go and sleep in the house. So they cannot enjoy it, right? So the SSA limit, only individual and half can enjoy the self-occupancy. Okay. For the other entity, this will not be applicable. Mr. SSA limit, Mr. SSA lets out to employ SBB at the rate of 5,000 per month, which is necessary for the purpose of business. Already told you, no. So if the business owner lets out the property for somebody else, subsidiary company, government entity, for smooth running of their organization, like even letting out the property for the banks. So in the very first class, I told you, right? For the TCS, they want to have a bank facilities within, so they let out a property for the bank. But letting out of property is not their intention, but facilitating their employees is the matter. The quarters are letting out to the employees, also facilitating for their business. In that case, this will be part of PGBP income. PGBP income. In a house belonging to Janak, his cousin is living without paying any rent. Janak says, since his relative is residing there without payment of any rent, there is no rental income. Will it be correct? No. So rent will be based on the notional income. Cousin is not relative. If the self-occupied property is occupied by the owner and his relatives, up to 2 house property will be considered as self-occupied only. No need to worry about that. But cousin is not forming part of family, so will not consider for the benefit. So he has to pay the tax based on the notional income. Clear? So with that, all the theory illustration, discussion illustrations also over. Let's now summarize the leftover content as well as section 27. Hope we have completed all these sections, including section 27 supposed to be completed now. Owner of house property, annual charge, etc. defined under section 27. And exemption. Section 10 gives the exemption for rental income from farmhouse and a ruler whose one palace will not be considered for the taxability purpose. Okay, king and his own palace. Palace will not be considered for the rental purpose. Okay, and section 11 and 12. If the house property held by registered charitable religious trust, that will not also be considered for the taxability exempted. Political party possesses any house property will also be not considered for the taxability purpose. So, political party, farmhouse and religious trust and registered religious trust and palace of a ruler, king, right? So, Mysore Maharaja, there's a Mysore palace, right? Possessed by the Mysore family members still will not be considered for the taxability. And under default tax regime, section 24 class B benefit is not available for the self-occupied property. The 32 lakhs limit, no, you have to forget completely. If you go for the default tax regime, in case of self-occupied property, 0 will be the value. You cannot show negative value for the house property. You cannot show negative house property if you are applying the default tax regime. Is that clear? This is the only one point you have to understand. Section 22 over, 23 1 over, municipal tax abroad over. Now, some few theory concepts like deposit. Now, what happens, you know, already told you A, B. A gives the property, okay, residential house property let out to B. Okay, charges rent to rupees 20,000 rupees per month and gets advance for 3 months 60,000 rupees. And A, B. A lets out his residential house property to B. For that, he gets advance rupees 1 lakh and rent being 16,000 only. Okay. Now here the advance is for what? To safeguard, to save. If tenant vacates without stating anything or damages the property, how can I recover? So I'll have a security deposit like to safeguard my revenue. If there is any damage at the time of vacating, I can adjust in this value. Okay, that's what about the case. Clear? Then your income from house property being 20,000. In this case, 1 lakh. Up to 60 may be for the safeguard purpose. Another 40, no. Because of the excess amount he collected, at the time of vacating the property, only 60 is going to be refundable. This 40 not refundable because it's anyhow adjusted for this payment. Rather than 20, he claimed only 16, stating that 1 year later, you will get only 60,000 rupees. It means that 40,000 is spreaded over for the 12 months. Like in that case, that 40 will also be includable. So into 12 months and this 40 will also be includable. Non-refundable deposit, if any, will be forming part of the rental income only. And A, B, residential house property and pays rent rupees 2,000 rupees. But advance paid being 10 lakhs. How much is going to be refundable? 10 lakhs. Stating that, sir, it's only advance, sir. It's only advance deposit, refundable deposit, sir. My rent is only 2,000. No, it's cheating. The advance seems to be exorbitantly high rather than 1 lakh or 60. Many fall almost 10 times higher than these advances. Immediately, income tax department says you charged only 2,000 because of the high amount you collected. You are enjoying the interest benefit. Because of the huge deposit, you have reduced the rental income. Otherwise, the rental income should be 20,000 rupees. I add that 18,000 rupees and I charge 20,000 as your rental income. Non-refundable deposit. Non-refundable deposits. If the deposit is not going to be refundable, then also be considered as a part of income, includable proportionately. But refundable deposit, provided if it reduces the rent payable, like this scenario, by way of interest benefit, A enjoys. So you have given me 10 lakhs, sir, you don't pay huge rent, just pay 2,000 rupees nominal rent. Then you are allowing him to pay only 2,000 due to huge deposit you collected, supposed to be refundable. But for the huge deposit, you are enjoying the interest benefit. No. In that case, 2,000 is not the rental income, 20,000 is the rental income. Hope you will be now able to understand. Now, let's go for doctrine of mutuality. Doctrine of mutuality is nothing but applicable for the NPOs, non-profit organization. Probably around 50 members form a club. They contributed fund for what? A club. And club now allows them, membership fees is given, allows them to enjoy the possession of house property of club. Okay, residential house property. So club gets the membership fees from all the 50 members, and using that fund, they purchased around 20 or 30 flats, allowed the members to enjoy the benefits. Will the club consider that being income from house property? No, not required. Not required. Because it's what about the principle of mutuality. You cannot make profit by trading with yourself. That's a logic. One cannot make profit by trading with oneself. Okay. So I have one pen worth rupees 20 in my shirt pocket, keeping that pen in my pant pocket from my shirt pocket and saying that, so I made a profit 5 rupees. No, it's not so. You cannot do. If the pen is in my pocket for 20, I'm transferring to your pocket and charging 25 rupees, then 5 rupees is my profit. I cannot say profit is made by transferring from my shirt pocket to my pant pocket. So one cannot make profit by trading oneself. So club is nothing but one family. One family. All the members put together, one family. So family cannot make the profit by transferring within the family itself. But a specialized facility is given by the club to these members for an additional fee, then this will be considered as taxable. Okay. For the membership fees, whatever the common benefits transferable, no, will not be considered as taxable income. This is called doctrine of mutuality. SSA Club, a private members club which provides entertainment to its members by offering accommodation, library, reading room, etc. The club also earned income by letting out its marriage hall to non-members. In case of non-members, it will fall under by making them temporary members. The club contends that doctrine of mutuality would apply in such case, hence its income would not be taxable. Discuss the correctness. CAT versus Banipur Club Limited. Receipt from members is exempt. And CIT versus Trivandrum Club. Receipts for temporary membership to avail the club facility is cheating, right? So it's taxable. It is taxable. Clear? One discussion case now. Hope now you'll be able to understand the concept of doctrine of mutuality. So we have completed that notional income is the matter, not the real income. Unrealized condition or rent condition also we have studied, and interest calculation also completed. Some notes for the interest calculation also completed. The last point we supposed to study is all about deemed owner, and the last case is this one. This one is already studied, right? Section 10 form and 10 class 19A, palace of a ruler, 11 and 12 religious trust and political party. If you are using the property for own business, not taxable. Up to 2 self-occupied properties, not taxable. In whatever scenario, income from house property is not taxable. For that, this list will be given. Now, owner. Okay. Registered owner, beneficial owner, everything we studied. Section 27 gives a list of 8 items called as deemed owner. May not be in their name, still they are owner for paying the tax and all. To calculate the income from house property, these deemed owner will be responsible. In the very first case, Mr. A transfers his house property to Mrs. A, or okay, child, minor son or daughter. Daughter being unmarried. Anyhow, this is not an issue now. Okay. Mr. A, Mrs. A. Mr. A has 2 house properties. One property is now registered on Mrs. A's name. Another one is for minor's name. Yet the income from the house property will be clubbed only in the hands of Mr. A, because there is no adequate consideration transfer from here to here. It's only cheating like. If all the rent is in my name, my income will be in the higher tax slab. I have to pay huge tax. In order to escape from that, I transferred the house property in my spouse's name where she has no income. If she receives the only rental income up to 5 lakhs and 7 lakhs, she may be enjoying the benefits, right? So in order to enjoy the tax benefit, he is transferring, not real motive behind. In that case, no other way, Mr. A being the deemed owner, though the registered owner being Mrs. A and minor son or daughter. Scenario 1. Scenario 2. Holder of impartial estate deemed as owner. Okay. Mr. A has 3 sons and daughter. Okay. X, Y, son and Z being daughter. Okay. They live in a residential house property. X being the senior. Okay. Residential house property they live. Suddenly, Mr. A demised. Still, that residential house property remains unpartitioned, now under the control of X. So, who is the owner for the residential house property? The registered owner being Mr. A. Mr. A is no more exist now. Okay, partition is not done. Now, who has to pay the tax? Currently, who is possessing, who is enjoying the benefit? X. The holder of this residential house property being X, not being the registered, still X being the deemed owner. Is that clear? Impartial estate. Not partition. Is that clear? Hope now you'll be able to understand these 2 cases. Let's go for the third scenario. Okay. Housing building schemes are there. Cooperative societies. X being the member of a cooperative society. This cooperative society is running housing building scheme. What they do know, very simple, they collect the membership fees and periodical installment like. And cooperative society, out of their own fund or loan, they could have constructed a colony like, or flats like. Okay, this colony and the flat will be in the name of cooperative society only. And based on the requirement of the member, some of them may be allotted. This particular flat is allotted to X. Okay, for that X has to pay the installment amount in installment. Okay, maybe 20 lakhs, and he has to pay around 1 lakh per year. Okay, on transfer of the last installment, the ownership is transferred to X. Until that time, the ownership is in the name of cooperative society only. Though the ownership is in the name of a cooperative society, the possession and all the benefits is now enjoyable by Mr. X by paying the membership fees as well as some installment. Then the deemed owner being X only. Deemed owner being X only. Right. A member of a cooperative society, or it may be a company or AOP, to whom building or part thereof is allotted or leased under a house building scheme of society, company, association, shall be deemed to be the owner of that building or part thereof. So he himself being the owner, deemed owner. Clear? Third scenario. Now, fourth one, possession holder of the property. A, B. A has given the consideration of the property being, sale consideration of the property being 100 lakhs. A has given 10 lakhs and accepts to give 90 lakhs later. A letter given, a deed is signed to give the remaining 90 lakhs later on. B hands over the residential house property, key of the residential house property, but registration pending. Registration pending. Is that okay? Registration still pending. So I have given the part of the amount, and for the remaining part, I accepted to pay in within due course. And the seller has given the key of the property, but registration not confirmed because balance amount I have to pay now. Now I am just possessing, and as per the Transfer of Property Act, part performance will be considered as transfer. Here transfer is confirmed hereafter. A being the real owner, not B. Though the property is in the name of B, who is being the real owner hereafter? A. Because yes, now considered as owner as per the Transfer of Property Act. Transfer of Property Act. Is that clear? 4 points over under section 27. Now, lessee of a building, Mr. A, Mr. B. Mr. A gives residential house property to B. Not let out, not sale, but lease. Lease. Lease for how many years? Lease for how many years? Okay. Lease for more than 12 years. Okay, more than 12 years. Lease period being more than 12 years. Then who is the deemed owner? Deemed owner. Mr. A being the deemed owner. If I am being the lessee, having the validity of lease period is more than 12 years, lessee being the deemed owner. Lessee being the deemed owner. Okay. Now, if this is less than 12 years, but extendable more than 12 years. Okay, less than 12 years. First initial lease period 5 years. Renewal will be done for another 5 years. So 5 plus 5 plus 5, 15. So overall, including the renewal period, exceeds 12 years. So automatically, Mr. A will be the deemed owner. Scenario 3. The lease period is less than or equivalent to 12 months. 12 months. Okay. Less than, not less than, equivalent to less than 12 months. Clear? But extended 100 years, no problem. So the original contract is only 11 months. Once in every 11 months, they are extending without any time frame. They can extend for 50 years also, no problem. In that case, Mr. B is the deemed owner, or he himself be the owner. Clear? Understand that original lease period is more than or equal to 12 years, then lessee is the owner. If the original period is more than 12 months, exactly 12 month or 1 year or less than 12 years, but extendable beyond 12 years, then lessee is the owner. Original period is less than 12 months and extendable any number of period, then lessor is the deemed owner, or not deemed owner, he is the registered owner. lease period is less more than or equal to 12 years, then who is the owner? Lessee is the owner. Or lease period is less than 12 and extendable further, then lessee is the owner. Not applicable if the lease period is less than 1 year and extendable any number. Okay, if the original lease period is less than 12 months and extendable any number of years, then lessor is the owner. Lessor is the registered owner. Now, holder of power of attorney will be the deemed owner. For example, A, B. Now the house property is in the name of A only, but A gives the power to B to do whatever he wants to do with the house property. Then it is called power of attorney. B has the power. Legal power B has. As per the legal power, B can sell the house property of A without A's consent because he has already given the power. Then who is the deemed owner? B is the deemed owner. Power of attorney. Actually, A sells the property to B, residential house property, and the consideration being say 100 lakhs. To register in the name of B, B has to pay tax. In Tamil Nadu, it's around 11%. 11 lakhs tax should be payable. B is not actually buyer. He wants to buy and sell. He's a builder or real estate owner. He wants to find one more buyer. He wants to sell this residential house property to him later. He sells the property to C later on for 125 lakhs. After transferring to register in the name of C, C has to pay again 11% on this consideration. What is that value? Around, come on, 11%. 13.75 lakhs. So the overall tax paid in this transaction being 24.75 lakhs. To avoid that, you know what they will do. A, B. A transfers the residential house property to him. B makes the payment, but registration not done. Rather than registering, he gets a power from A, power of attorney from A. The power of attorney, power is given to B to do whatever he wants to do with respect to the house property. Later, B finds one more customer, C. For him, this residential house property is transferred and he gets the money here, 125 lakhs. And now finally the registration is done only in the name of whom? C. Then the registration fees in this case is 13.75 lakhs. He saves that registration fees to register in his own name. Because of that reason only, the real estate business people, most of the cases, they will just get the power for the house property by paying 50% or 40% of the consideration. While finishing the full sales, they will settle the remaining amount. Okay. Now A is also pretty comfortable because he gets at least 50% amount. Right. 50% he gets already. And also, he is not in tension to find the customer. Now B is also making profit and B connects with other customers to buy. So all the service rendered for him, there is a profit. Is that clear? Directly his profit being the difference between these two 25 lakhs. In this case, the difference between these two 25 lakhs, he has already paid 11 lakhs, so 14 lakhs is gain. In order to increase the gain, he usually gets the power of attorney. If I get the power of attorney, then the power of attorney holder will be the deemed owner. Clear? In this case, holder of that power of attorney being the deemed owner. What happens, sir, in case of disputed ownership? Already we have studied, if there is a dispute, currently who is owning and who is enjoying the benefit is the owner. And building owner is the deemed owner. Already explained in the very first class itself. Land may be owned by somebody else. I may get the land in rental or lease and on that I can construct the building. In that case, I am going to get the collections only for the building. The building income will be considered as income from house property. Is that okay? The land rental will be considered as income from other sources. Clear? Where the property has been constructed on leasehold land. Okay. Therefore, legal ownership itself is not criteria for assessment of income under the income from house property. It's not legal ownership. Beneficial ownership, even deemed ownership also explained under section 27. With that, income from house property is completely over. Okay. Next, we will